Hello guys, so in this session let's try to decode the price to earning ratio or the price to earning multiple. Price to earning multiple. Now it's one of the most important valuation multiple being used in the field of financial modeling and valuation. Let's try to decode it. So the price to earning multiple basically talks about the current market price of the share in the numerator divided by the EPS of the company. Now, EPS is the earnings per share, and we all know that EPS is the proxy for the profitability of the company. How is EPS calculated? It's the profit after tax divided by the outstanding share. So higher the profitability, higher would be the EPS. How is the profit after tax calculated? That's very simple. That's the total revenue of the company minus the total expenses. You get the EBIT, that is the earnings before interest and tax, or the operating profit of the firm. You tend to subtract the interest payment, tax payment, and if dividend is there, you subtract the dividend after the payment of tax. And then you get something called as PAT or EACS, earnings available to common shareholders. So we take the PAT in the denominator. In the numerator, we have the current market price of a company. So as of now, as of today, if I want to calculate the price to earning multiple for any of the companies, so I shall be taking into the current market price as of today, not the price as of 31st of March 25, but the price as of today. But the EPS number is something which I shall be taking as of the year ended 31st March 25. The reason for that is the numerator number, the current market price, that's a leading indicator that keeps on changing on daily basis. There might be some positive market sentiments, there might be some negative market sentiments, and also some speculation. And basis upon that, the numerator will change on daily basis. But EPS is something that we do not get on daily basis. No company declares the EPS on daily basis. EPS is something that we can either get on a quarterly basis or annual basis. So generally companies tend to take yearly number because the quarterly numbers can be a bit hazy, they can be a bit shaky, they can have the volatility element into the numbers. So we try to streamline those numbers and we take a yearly EPS here. And that is the reason we do not take daily EPS. And we call the numerator being a leading indicator because it tends to change. It tends to fluctuate on daily basis based upon market sentiments and speculation. And EPS is a lagging indicator because that is as of the quarter ended number, and a higher EPS might not get repeated in future, and vice versa is also true. So basically, this metric is telling us that how much we are willing to pay, how much as an investor we are willing to pay for a 1 rupee or $1 worth of earning of a firm. So for example, if the price to earning ratio for a company comes out to be 2, right? So basically it means for a $1 worth of earning or a 1 rupee worth of earning, we are willing to pay 2 rupees for that company. So that's the interpretation of the price to earning ratio. Now the thing is, in books we tend to learn that buy an undervalued stock or buy when the price to earning is low and sell when the price to earning is high. It might be overvalued. But one thing here we need to understand is that assumption might not work in real life, right? So price to earning में क्या होता है? It might happen the ratio is very low, right? And when will this ratio be low? Simple maths, fractions का फंडा maths का, when the EPS is high, in that case it's fine. If the EPS is increasing, the EPS number is strong and the price is low, then we can say the profitability of the company is too strong, but the price the company is commanding in the market is too low. Hence, the company deserves a higher price. In that case, we can 100% say the company is undervalued and we can think of purchasing that stock based upon some other metrics as well, right? But the price to earning can also be low if the company exhibits no future growth potential. There might be no growth potential for the company in future. Based upon financial modeling and valuation, the management of the company might not be strong upon the future outlook of the business. They might not be expanding, going towards diversification opportunities. Their management commentary might not be so strong. Their conference calls might not be so strong, right? There might not be any kind of bullish sentiments about this company in the stock. Growth ही नहीं है तो P high क्यों होगा? In that case, it can happen that the price to earning is low. In that case, purchasing that stock, seeing that the stock is undervalued, it might be completely wrong, right? So अगर price to earning का नंबर कम है, वो हमेशा ये indicate नहीं करता कि stock को खरीदो ही. Stock खराब भी हो सकता है fundamentally, poor stock भी हो सकता है और penny stock भी हो सकता है. On the vice versa, it might happen that the price to earning of the company might be high, right? Now one reason can be the EPS might be low and the price to earning is high. The other reason can be the EPS might be high, but the price to earning multiple might be justifying the valuations, right? And the growth should be there. So if the EPS is justifying the valuation, if the price at which the stock is trading in the market is justifying the earning growth, because as we popularly say that the valuations should justify the earning growth. अगर valuation ज़्यादा भी है, but EPS भी ज़्यादा है, it's fine, right? And company में growth दिखनी चाहिए. So if we can see the earning growth in the company, the EPS is being high, the profitability of the company is strong, and we can see the growth momentum in that particular stock. The management commentary might be strong, the conference calls, all these things might be indicating a bullish sentiment about the company, including its future opportunities, expansion activities, diversification opportunities. So all these things might be indicating a bullish sentiment in that stock, which might be really good. Then why not have a neutral approach or a buy approach towards that higher valued P multiple stock as well? So that is something we need to understand ideally. Now here also we need to understand a thing in case of price to earning ratio is, the price to earning ratio is being popularly used for, usually in the market, the analysts or the fund managers tend to use the price to earning ratios for all major type of companies. But here we need to understand that for cyclical businesses, heavy industrial businesses like defense, metals, oil and gas, right, power businesses, real estate, cement kind of businesses which tend to be cyclical, right, price to earning cannot be used. For those kind of businesses, either price to book value is used or EV to EBITDA multiple is used. We'll talk about those multiples separately as well. And also in case of the BFSI space, the banking companies, NBFCs company, insurance companies, price to earning cannot be used. We tend to use price to book value, price to embedded value for insurance companies. We'll be talking about these multiples in the subsequent videos as well. But the thing is, price to earning ratio cannot be used for all the companies present as an index, present in the index per se, right? Majorly price to earning companies is being used for asset light businesses, IT, right? It can be used for some businesses like which are somewhere between asset light and asset intensive. For example, it can be used for the automobiles business, right? And again, if we talk about FMCG kind of companies, hospitality, healthcare, right? So basically for all those sort of companies, price to earning is a very good metric. So that's about the price to earning multiple being a very important valuation metric in the field of financial modeling and valuation. Thank you so much.